Coming up today, stocks bounce going into the long weekend. A look at Nvidia stats. Where seasonality says we go next. Durable orders comes in hot. Consumers still worried about inflation. And the bullish case for copper. Hey, what's up guys? Welcome back to the Click Capital Daily Market Review. I'm your host Jared. Thanks very much for tuning in with me today. And if you're interested in markets and want to stay up to date with everything that's happening, then show some love and hit that subscribe and like button to let the algo know that you want to keep seeing more of these videos in your feed. And I'll keep doing my best to keep you updated on everything important happening across financial markets. And so we just finished out the week on a bit of a bounce going into the long weekend with the market shut on Monday in observance of Memorial Day. And so we got that big bearish engulfing candle yesterday and did a little bit of a bounce back today in a very similar pattern to the last couple of times we got the bearish engulfing pattern. Early April, we bounced back even more the next day, and that went on for 3 days when the market consolidated, then rolled over a little bit. We also got the same pattern with that bearish engulfing back in July last year. The market bounced the next day, held up for 3 days, and then rolled over for the next couple of months actually. So we'll be looking whether we repeat this same pattern going into Tuesday and Wednesday next week. And for the candle to be invalidated, we'd need to close above its high, which is also an all-time high, around 53.40. On the S&P 500. And so the market had a little bit of a pullback this week, especially so when looking underneath the hood instead of just the main index price action. This is a chart of the percentage of S&P 500 stocks above the 20-day average. And you can see this week, coming into this week, we're at 75%, 3/4 of stocks above their short-term average. Finishing the week less than half, here at 45%. Same deal with the 50-day, about half of all stocks above their medium-term trend. However, that didn't really show up in the VIX. Even though most stocks rolled over a bit this week, the VIX was pretty much flat, actually finishing below 12 here. And stick with me today because I'm going to show you some interesting stats, why I think we're in a really low volatility environment that could persist for some time yet. But before we get into that, let's talk a little bit about the star of the show. This week, Nvidia and their blockbuster earnings, beating estimates by 9.3%, announcing a 10-for-1 stock split, which will happen on the 10th of June, shortly before they pay out a dividend to shareholders. And it put in another good day today, up 2.5%, closing at all-time highs. Now trading at 10.69 post hours as I speak. So it's definitely the talk of the town today across the financial sphere, with plenty of divergent views. Some people saying this is just the start of the AI revolution. Others saying it's clearly a bubble and they won't be able to maintain their dominant market share as competitors like AMD and Intel are likely going to step up efforts to compete. And now with Nvidia's market cap above 2.5 trillion, just to put that into some context, looking across global equity markets, just Nvidia, the company alone, has a bigger market cap than the entire Australian stock market, than the entire South Korean stock market, and now also, hard to believe, but the entire stock market of Europe's largest economy, Germany. With Canada a mere 500 billion higher, and who knows, it may eclipse that over the coming weeks and months as well. And that has got the market excited for Nvidia here and now. We can see that in the call options now coming back, which have been persistently at the same peaks from 2021 this year, and especially so now. And I'd say that's likely to remain the case going forward. And we can see that show up in the option volume leaderboard. Again today, Nvidia absolutely smoking the S&P 500. Almost $4 billion in notional call option volumes versus the $500 million in the S&P 500. And it isn't just all hype and sentiment either. There's good fundamental reason for the surge in Nvidia price and volumes. What you're looking at here is a bar chart of Nvidia's market share, starting from the first quarter in 2018 to where we are now. And you can just see that explosive move up over the last 4 years. Prior to that, in the dark blues, Intel, absolutely dominating the industry for many, many years. Up the top in the grey is AMD, which has increased their market share. And just look at that squeeze from Intel and the huge rip in Nvidia, now approaching 80% market share in GPU chips. Not only have they massively increased their market share, they've also been able to increase their operating margins. Typically when companies increase their market share, they do so through lowering prices, becoming more competitive, like we saw in the long-term trend of Amazon taking away market share from Walmart through competitive pricing. However, Nvidia is the exception. Now got operating margins at all-time highs at 70%. And so in my 20 plus years of trading and investing, I've never seen a company like it. This size, putting in these numbers of market share, growth, operating margins, being able to sell their chips for $30,000, $40,000 a piece and turned it into just an absolute cash machine. However, naturally people look at the huge ascent in the stock price. Just speaking technically, this is not my chart here, this is someone else's chart, and they've drawn in kind of a line of regression, mean reversion, which currently sits at 325, and they've drawn out a bit of a potential head and shoulders pattern and saying that it's in an unsustainable move, and maybe that $1,000 psychological area is its peak. However, the reality is no one knows. going back in bubbles. It could be its peak, 1500 could be its peak, or it could top out at 2000. That would be $200 split adjusted. Nobody really knows just how crazy the late stage move of a huge run up like this can get. However, what we do know is we've seen a big bounce back in semis thanks to Nvidia. And just looking at semis versus S&P 500, 21-day outperformance, now around 15%. Looking back over the last 5 years, that's typically where we'll see semis pull back. And there's a look at the Semiconductor ETF, which is currently a little technically overbought. Looking at my DSI, it's reached the overbought levels. Has range strength negative, not a clear sign that we're in a big momentum, clean technical breakout here. And just looking at some other key semi stocks like AMD, they're well off their highs. Broadcom's consolidating just below its highs, whilst Taiwan Semi is currently sitting at its highs as well. And we've even got some like Wedbush, who says next up to outperform is the sleepy Apple, which has pretty much done nothing for a couple of years. He's making a bold claim saying Apple's poised to surge nearly 50% as it comes up to the WWDC event on June 10, which they're going to launch the new iPhone 16. And Dan Ives says that'll push them into a new super cycle, take the market cap above $4 trillion next year with his new price target at $275 a share. Said he'll be looking for a lot more news and ideas coming from them in regards to AI and how they're evolving the company around this new trend. And that's quite a bold claim, given the market cap's already almost $3 trillion. Growth has been flat and slightly negative over the last couple of years. A lot of people have been suffering from upgrade fatigue, constantly getting pushed a new version of the iPhone every couple of years when they're all basically the same thing. And so the bar is set very high for them to deliver on good growth numbers in iPhone 16, especially since the new Vision Pro headset isn't exactly taken off like many people had hoped for, and they're suffering a lot of weakness in China. As like a lot of industries, China's key domestic players are taking market share from the big American brands. We've seen that with Tesla, Starbucks, and other companies that have a key presence over there. And so just getting back to market volatility, just looking at this bar chart here of the 15-year percentile rank of 3-month implied volatilities. In the light blue, the end of Q1, dark blue, the 15th of April, when we had that dip, and in the grey current. And it isn't just the stock market either. We can see the S&P 500 at a 7% percentile rank from a 15-year range, showing it's near rock bottom lows, as is the VIX. Bond volatility's come down a lot as well, and FX and oil volatility, both of which at the low end of their volatility ranges as well. And we can see that in the long-term monthly chart of the MOVE Index. Bond market volatility ripped up big time in 2022, plateaued last year, and now it's turning down. And going down to the daily chart, we can see it's in a bit of a downtrend now, lower highs, lower lows. And so that's a good sign for financial markets overall. When interest rates and yields are not moving around so much, that leads to more financial stability and just shows financial conditions are actually loose. They're not restrictive, as Jay Powell would lead you to believe. And so that's showing up in the S&P 500 and the amount of days without a 2% daily move. That's up and down. Now above 300 trading days. The only other times we've been higher than that was in the really low volatility year of 2017 and the really low volatility period 2004 going into 2007. And just looking at a long-term monthly logarithmic chart of the VIX, taking you back to that period in 2004, 2007. I was trading during that period, and something that had happened in that period from the early 2000s, there was a big switchover in the industry, kind of the crescendo of the wave, if you will, from open outcry, physical manual trading, over the phone, really going into electronic trading, electronic markets, decimalization of stocks from trading in 1/8 of a point into 2 decimal places and cents. A lot of exchanges and companies increasingly moving most of their trading volume on screen and electronics, and that was a big trend in the early 2000s. And then a lot of people attributed that to the decrease in volatility from 2003 going into 2005. In fact, I remember headlines back then, volatility is dead, it's never coming back to the markets. Markets are super efficient now, thanks to the electrification of markets and the controls, excess liquidity, etc., etc. However, then we had the subprime crisis, GFC, and the VIX shot up to almost 100 after it sat down there for a couple of years, around 11-12 handle. Then we went into that high volatility period, and you'll find that with volatility, it kind of clusters and goes from one regime to another. And so from 2008 to 2011, we had a bit of a banking crisis, especially in the Eurozone. They had problems with debt, and that kind of subsided. The Fed really supported the market really well. Plenty of quantitative easing, rock bottom low interest rates, nothing really to shake the markets. And again, we went into that low volatility regime, which bottomed out in 2017. Then we picked a bit up off the lows. Then of course, COVID shot us back up to a VIX on 85. Huge amount of government and Fed stimulus. Bit of a high volatility regime for a couple of years. and here we are now. So it's very well possible that we could come back into this low volatility regime that lasts a couple of years. And of course, there'll be spikes in between that, but you can almost be certain that we'll eventually go back into a high volatility regime at some point. And so this current streak without a 2% daily move could grow further yet, just like we saw going into early 2007, we got to almost 900 trading days without a 2% move. People were convinced volatility had left the markets. It caused a lot of pain for trend followers and managed futures as well. However, they came back in a big way in 2008 because you could kind of think of trend following as crisis alpha. It does really well when pretty much everything else is not. And a big part of the current market regime we're in is the absolute dominance of the Magnificent Seven, those big large cap tech stocks, now representing 31% of the S&P 500. It's an all-time high. And again, it's not all hype and sediment. There are fundamentals backing this market. Corporate earnings growing again, along with analyst revisions. We can see that in earnings sediment. S&P 500 shooting up a lot this last month, along with the Euro Stoxx 600 as well. We're also seeing those loose financial conditions in the bond market. Looking at investment grade bonds, that's companies that have good credit ratings, good balance sheets, abilities to repay debt. Currently trading around 87 basis points above treasuries. Same with high yield debt, also known as junk bonds. That's companies with more risky balance sheets and financiers require a higher premium to lend to them. Currently around 3% above treasuries. And that's well off highs and down near record lows, showing the bond market's not pricing much risk in for corporate borrowers at all. Again, showing liquidity is aplenty. And just looking at the here and now in the stock market, looking at the average performance per day going back to 1950. So this is not election year or anything. This is just every single trading day. Over the last 74 years, we're going into one of the most bullish 2-week periods there are. In fact, the forecast for next week is we shouldn't have any down days. And the first week of June, historically the worst down day is 1 basis point, pretty much flat. So we've got a strong seasonal period coming up over the next 2 weeks. And that's expected to be further supported by a forecast increase in Fed-backed liquidity as they decrease their balance sheet reduction. Looking at an index of liquidity proxy, that's actually expected to start increasing mid-June, taking us all the way through to September, and even higher finishing the year out as well. Although stepping back, there's still a bit of a divergence between the Fed reserves and the S&P 500. This is something we'd been tracking a lot in 21, going all the way into 23. There was a big correlation after COVID between the Fed's balance sheet and the stock market performance. However, the stock market's broken away a bit to start this year and is tracking well above where Fed reserves are. And just stepping back further again, even though the setup for the here and now is very bullish, seasonality, technicals, just looking at the long-term holistic picture, looking at 20 different valuation metrics, all but one, the United States stock market, is very expensive relative to history. Whether you're looking at the trailing PE, forward PE, Schiller PE, price to book value, price to free cash flow, dividend yield versus treasuries, US stocks are very expensive. And that generally correlates with poor returns going forward, even though, like I said, this year is looking very bullish. Could be a case the market has a real chance at topping out next year, if not 2026. And a top in 26 would actually line up with the Benner cycle. And that was created all the way back in 1875 from a trader named Samuel Benner, who published a book called Benner's Prophecies of Future Ups and Downs in Prices. And for the stock market, the Benner cycle is a model that Benner developed to predict the ups and downs. It consists of 3 lines, A, B, and C. The A line represents years of market panics, which occur in a 54-year cycle that alternates every 18, 20, and 16 years. The B line represents years of good times and high prices, which alternate every 8, 9, and 10 years. This is the time to sell stocks and other assets. And then the C line represents years of hard times and low prices, which are a good time to buy stocks, and they align with another type of cycle analysis called Foundation for the Study of Cycles, which has a strong community, and that actually pointed to a low in 23, which it almost nailed as well since the market did bottom out in late 2022. And there's a look at the Benner cycle graph. Kind of crazy to think he created this in 1875, and quite a few times it's lined up with good times to sell stocks and to buy them as well. Saw that in 72, 99, 2007, buying them in 05, 12, and 23. And there we are, 2026. That's the B cycle. Years of good times, high prices, and the time to sell stocks. Predicting the next best time to buy will be 2032, and then we could have a panic in 2035. And he almost nailed the panic of early 2020 COVID with his 2019 prediction as well. So it'll be interesting to see if the Benner cycle plays out, and if so, this rally could still have another year or so left in it, which I think is possible as well, given how loose financial conditions are, how supportive the Fed and Treasury and government are, and just the lack of understanding from the general public of what the Fed and Treasury have done to inflate asset prices, which has pretty much just benefited those at the top at the expense of those down the bottom, paying for all that by the way of inflation and a greater percentage of their salary. And just looking at the latest research from Goldman Sachs on their macro views, globally they expect real GDP growth of 2.7% year over year this year, reflecting tailwinds from strong real household income growth, a gradual recovery in manufacturing, and a start to rate cuts as inflation cools. They expect global core inflation to fall back to around 2.5% by the end of the year, on the back of falls in shelter and services inflation coming down. Looking at the US, they expect above consensus GDP growth of 2.4%, and they believe the Fed will remain on hold at the current Fed funds rate, and they're actually expecting a cut in July, and then they expect cuts to proceed at a quarterly pace, with the next one in November. In the Eurozone, they're expecting GDP growth of 0.8% this year. Inflation is slow. ECB going to cut in June. And looking out to China, they expect GDP growth of 5% this year, along with some more deflation. And said just to look out for conflict in the Middle East and other geopolitical risks, along with US politics. And just looking at some economic data we got out today, durable goods orders in the States, month over month, came in way hotter than expected. Economists were forecasting a 0.8% contraction, actually got 0.7% expansion, and that's the third straight month of gains. And basically durable goods orders are just exactly as it sounds. For things that are durable, typically lasting longer than 3 years, cars, machinery, electronics, it's a sign of strength in the economy. And that didn't have a huge effect on treasury yields today. However, bond yields are pretty firm this week as we're continuing to get more of these hot economic prints, further pushing out the chances the Fed can cut rates anytime soon. And the price action in the 2-year yields looking pretty constructive here. Now back within an inch of 5%, likely upsetting Jay Powell and Janet Yellen after they talked them down from the first of the month down to 470. We've shot back up, along with the market pushing out the odds of when the Fed's going to cut rates. Now looking at November and only pricing in one rate cut this year. Contrasting the hot stock market, AI boom, companies doing well, is consumer sentiment. Although coming in a bit better than estimates, still decreasing, as most consumers are still grappling with high embedded inflation, except for this guy here, who's doing really well in his satin threads. Most people not feeling so good, as the prices of food still feel like to most people are going up a lot more than the 3% rates that have been reported to us. And just looking at some research from Bank of America, they're expecting core personal consumption expenditures, that's the Fed's preferred gauge of inflation, to come in well above target again in April, around 2.93% on a month-over-month annualized basis. And we can see starting this year, core PCEs definitely bounced back after it was really contracting going into late last year. Fed was thinking we're good to start cutting rates soon. The market was priced in rate cuts in March and priced in as much as 6 rate cuts this year. Then it appears Jay Powell, just through his language, reignited animal spirits and maybe actually contributed to the bump back up in inflation. In other words, he spoke too soon. However, as I regularly remind my viewers, it's not supply chain disruptions, it's not Vladimir Putin, it's not any of the other things the Fed contributes to the rise in inflation. It is nearly entirely because of the US government spending, along with the Federal Reserve and their years of overstimulating the economy with rock bottom rates and printing $9 trillion of artificial money. Of course, that was going to find its way into the prices of goods and services we all pay. And just look at the total government spending. It's already on a sharp uptrend going into COVID. Then after COVID, they just took it to a whole new level, into the stratosphere, spending like crazy, and they still haven't even pulled that back into trend. The last 12 months, US government spent $6.3 trillion, while they've only taken in a little over $4 trillion in revenue and tax receipts, creating a huge budget deficit, meaning they have to sell a lot of bonds, which in itself keeps upward pressure on rates. And they've created a huge interest expense, currently trailing over $1 trillion in the last 12 months and just about to overtake defense spending. And it won't be any of the current day politicians that pay for that. It'll be the young people in the future through increased taxes and decreased social benefits that end up paying for all the current day political spending that's taken place since 2020. And this isn't just occurring in the States as well. Like I always say, here in the West, we're quite synchronized in our economies and the trends, and isn't just a soft consumer retail spending and sentiment in America, it's also happening in the United Kingdom as well. We saw their retail sales plunging 2.3% in April, missing estimates, and it could be just a case that AI is masking the weak consumer sector. And like we can see from the charts, the market doesn't really care about this weak consumer. The dominant theme is AI, and that spillover effects even into sectors like utilities. And of course, the hardware that powers AI and commodities like copper, which is a key industrial metal now for the electrification of the world, electric vehicles, artificial intelligence, even used in the production of military missiles. We've got one hedge fund manager predicting the metal could catapult to $40,000 a ton within just a few years. That'll be a 288% surge from its current price of a little over 10,000 a tonne. And like a lot of commodity markets, this too's in a supply deficit, and so this very well could likely play out. Along with my other favourite commodities, uranium, gold, and to a lesser extent, hydrogen and other new forms of clean energy. And that's got the strong tailwind of the biggest AI app out there. ChatGPT uses 10 times more power than a simple Google search. Daily visits to the ChatGPT site have been flatlining for about a year, but over the last month or so, it's actually shot up to new highs. More and more people are adopting the technology. And speaking from personal experience, I've been using ChatGPT way more than Google for well over a year now. And it looks like fund managers are coming around to the commodities trade. We saw that in the month-over-month change in their percentage overweight in commodities, spiking up this month. Last time we saw those spikes was in June 2020 and March 2016. And so there's a look at a clean, long-term monthly chart of the Commodity Index Tracking Fund, ETF DBC. And that looks to be pushing up close against this downward trend. And the last time fund managers really increased their exposure to commodities was back in June 2020, right before the commodity market went into a strong rip for a couple of years. Prior to that was back in March 2016. And again, commodities went on to rally for another couple of years. So it looks like fund managers are getting back into commodities here. And if I just overlay this monthly chart with the year-over-year change in inflation, you can see there's quite a bit of correlation between commodities and inflation, with inflation well below commodities here. And so like I said, if commodities as a whole, the whole complex, energies, metals and softs, they all break out together, it's going to be a miracle for inflation to keep going down. And instead we could be in for a second and higher 70 style wave of inflation. And personally speaking, I've moved a significant portion of my own net wealth into land REITs, as a lot of them lease out farmland and the leases are indexed to CPI inflation, so they can actually benefit from higher inflation as the rents go up in line with inflation. And it's at least a good hedge and good income, and they have good valuations, especially compared to the main US stock indices. And so that's an area of the market I plan on staying invested in for at least a couple of years, if not much longer. And being a bit of a contrarian at heart, it's charts like this that get me excited to stay long commodities and land. Looking at the relative price difference of tech stocks versus commodities, had that huge run up in the 90s. Tech stocks absolutely collapsed, along with going into a commodity boom that peaked out into '08, and for the last 15 years, and for a lot of people in this market, all they've known is tech and growth outperforming, and they're conditioned to believe that's how the market always works and always will work in the future. However, I think a little different. And my regular viewers will know other areas of the market I've been invested in and talking favorably about for quite some time now. Not just commodities like gold, copper, uranium, clean energy like hydrogen, Chinese stocks, farmland. Another area I've been invested in is cannabis. And my thesis is that one day the entire market cap of the cannabis industry will eclipse that of alcohol and tobacco, and potentially combined. Largest alcohol and tobacco companies in the world have market caps in excess of 100 billion. The whole cannabis industry has a market cap not even 30 billion. And just looking at the fundamentals, in the States now we've seen a huge increase in the amount of people consuming marijuana on a daily or near daily basis versus alcohol, and now actually eclipsing that. There's more cannabis users than there are alcohol users as society catches up with the science. One's an artificial poison, the other one's a natural plant, and like everything, eventually the truth prevails. And that's why I'm still bullish on the overall cannabis sector, even though we've had a bit of a sharp pullback this last month, looking at MSOS ETF, maybe finding support around the $8 level. If not, we may come back down to $7.50, and that could potentially set up for another dip buy. But don't get me wrong, this is a highly volatile sector. It's going to be a bumpy road ahead for a few more years. As you could kind of think of cannabis going through the dark ages for 100 years, it's going to take a little while before society and especially government fully embrace it and accept it for all of its benefits, not just recreational, but also medicinal and even industrial as well. The plant has many uses, much more than tobacco and alcohol. Moving on, we've got the Fear and Greed Index still in the neutral zone at 53, and corporate insiders pretty much doing a normal amount of selling versus buying. There's a look at the dollar index, still consolidating around 104. Same with Bitcoin, still consolidating just below highs. Gold found its footing above 2,300 an ounce. Along with crude, appears to have been bought the dip. Bit of a sharp pullback in natty gas. Uranium still in an uptrend, along with wheat, corn, and especially orange juice. Look at the run OJ is going on. This looks to be going the way of cocoa did a few months ago. Also got soybeans sitting pretty, and coffee making a move back up as well. Bit of a pullback this week in Chinese securities, potentially offering up a buy the dip opportunity, and clean energy putting in good technical signs. This just may be a bottom we may not see again for quite some time, especially with a strong price volume action. And one of my favorite areas of the clean energy market, hydrogen, putting in a really good week this week, up on big volume. Looking across global stock markets, equity breadth, all indices above above their 50-day VWAPs and in technical uptrends, especially the spread of copper versus gold. Good sign of global economic growth. That's uptrending as well. But like I said, the divergence is in consumer discretionary. There's the spread of discretionary versus staples, now in a downtrend for the last couple of months. But we can see staples versus the S&P pulling back these last few weeks. So it's more of a case of discretionary companies are weak versus an overall big defensive trade in the market, as we can see in staples versus S&P 500. And this rip in utilities, which would normally be contributed to a defensive rotation, I think it's actually running now on the AI boom and the surge in electricity demand. And this trend could persist for some time yet as well. There's a momentum factor, getting back to highs. Market's feeling really good. A little bit of a bounce there for Tesla, just trying to hold ground above the 50-day. Big rip in solar stocks this week. There's a look at Enphase and First Solar, one of the best performing stocks this week. Absolutely ripping up on huge volume here. Also spilling out to the entire industry with the solar ETF 10 moving up on good volume. And we've also got staples like Costco, Walmart, and Procter & Gamble still holding on to their uptrends as well. Whilst the large financials are still sitting above their 50 days, managing to hold on to their uptrend. Right, there we are for the week, guys. Pretty much consolidated on the S&P 500, just hanging around 5,300 now. And looking out to next week, remember we're shut on Monday for Memorial Day. We don't have much out in the economic calendar. Some GDP growth coming on Friday. And remember with that seasonality I showed you, and the fact that whenever we have a week with not much out in the terms of economic data, generally bodes well for the market, along with a forecast increase in Fed liquidity. Unless we got some sort of shock or surprise, I don't expect the market to fall between 5,200. I'd say we could potentially consolidate, maybe trickle down, and market liquidity and the VIX so low, even this week with most stocks pulling back. The VIX couldn't even finish above 12. I'd say we're going to be trading thick and keep consolidating here for a little while before we come back and test these all-time highs. Thanks very much for sticking with Click Capital. Truly appreciate all your support. Have a great long weekend, and I'll see you guys again Tuesday night. Cheers.